And now we have almost no inflation. We've done a great job, and we should have the interest rates cut.
Hello, everyone, and welcome to the Week Ahead on Nomura podcast. I'm Yuben Paracuelas, Chief Southeast Asia Economist at Nomura in Singapore, and today is Friday, the 18th of July. I'm recording this podcast from Kuala Lumpur, and I must say optimism among investors here on Malaysia's domestic economy remains intact despite the external environment. But of course, the big questions of the day came up at every single meeting in some shape or form, and these are exactly what we will cover in this episode. In the US, David Seif, our chief economist for DMs, will talk about how tariffs are starting to show up in the latest US inflation data, supporting our view the Fed will stay patient despite President Trump's continued push for the Fed to cut rates, as you heard there in that clip earlier. David also shares his thoughts on why Chair Powell will likely finish his term. In Europe, Andrei Shepeniak previews the upcoming ECB decision and how the threat of a 30% tariff on the EU might influence the ECB outcome. In Asia, Jing Wang from our China economics team talks about the evolving Chinese growth outlook, US-China relations, and the importance of watching the mid-year Politburo meeting towards the end of the month. Finally, all eyes on the Japanese upper house elections this Sunday, and Kengo Tanahashi-san from our economics team in Tokyo discusses scenarios of possible outcomes and why these could each have significant implications for financial markets. Let's dive in. Okay, now let's kick off with the U.S. and very delighted that David could join me today. Hey, David, thanks very much.
Hey, pleasure to be here, Yuben.
Okay, so it's a relatively light calendar in the week ahead. So let's zoom in on the U.S. inflation outlook. And, you know, we've had the latest numbers. I'm wondering what your main takeaways from there, especially with regards to whether you're seeing signs that, you know, the tariffs are starting to show up in the inflation data, and whether that could intensify, and what does that all mean for your Fed call?
Yeah, absolutely. So we certainly did start to see for the first time inflation related to tariffs beginning to come in. So goods that have a high import share, or even services that are related to tariffs, start to pick up in the inflation numbers. So although the overall core print was a little bit lower than consensus, although I should point out in line with our forecast, the key thing was the details, that it was what inflation we did see was tariff related. And I think that the slightly delayed reaction from markets to eventually see this as a bit hawkish, not a bit dovish, was the correct response. Now, we expect that these tariff-related, the tariff-related inflation is only going to increase in the coming months. And very honestly, it was a bit more than we expected this month in this print, but it shows signs, bottom line, that are in line with our thesis. So we have had a very long-standing call that the Fed would not cut until December. This was so one cut for the year. This was a call that we had when the market was pricing in 4 cuts, and we certainly have no intention of changing that call based on the data. The data were very much in line with that. We now have, for the first time, September Fed cut pricing at only slightly higher than 50%. And fewer than 2 cuts priced in for the year. So that means that the market has come significantly more in line with our view, although our view is still more hawkish than consensus. I would say that on top of all that, we've continued to see the labor market do all right. And that's an important second component. Yes, the details of the last couple of labor market prints were not as strong as the headline numbers would indicate, but they weren't terrible by any means. And so there's very little to indicate that that any sort of labor market weakness is going to push the Fed to cut, and that allows the Fed to really zero in on what's going on with inflation, Are we seeing signs of tariff-induced inflation? And I think clearly now the answer to that second question is yes, we are.
Yep, great. And speaking of the Fed, obviously that's a hot topic now is on, the media headlines regarding Trump potentially firing Powell soon, which the president seems to have later denied. Any thoughts on that?
Yeah, well, that was a fun 45-minute or so heart attack for the markets here. I would say that it remains not our base case that Trump will try to fire Powell for the biggest reason that Powell only has 10 months left in his term as Fed chair. There are just 7 FOMC meetings left where he will be Fed chair, and sort of the cost of attempting to do this for Trump is likely to be higher than the benefit, because the benefit is just for a 10-month period of time. I think that it remains a left tail risk, and I certainly don't think we should ever rule out anything that Trump will do. But to the extent that one of the aspects of yesterday's news cycle on this was a trial balloon, I think the adverse equity reaction, and perhaps even more importantly, adverse back-end treasury reaction probably lowered the odds of this actually happening than anything else. I would say also that we need to really think about sort of let's just assume for a moment that Trump did fire Powell, that the courts upheld it, that Powell left, and that Trump rapidly put a new Fed chair into place who was going to be much more dovish than Powell, and importantly here, more dovish than the rest of the committee. We need to remember that actually at the end of the day, the FOMC is a voting committee, and it takes a vote. For the past 40 or 50 years, arguably longer, the Fed has operated as a de facto dictatorship by the chair. And that's a model that's worked very well when the Fed chair has focused in on making sure that he or she was not too far out of consensus and had the support of the FOMC. But if there were to be a Fed chair who really pushed for far more aggressive cuts than the Fed, the FOMC as a whole wanted, then we have to start sort of dusting off the proverbial rule book that hasn't really been looked at for a long time and start to think, well, this is a vote. The Fed chair can't just do whatever he or she wants. Another rule is that the FOMC chair does not need to be the Fed chair. It always has been, but the FOMC could elect somebody other than the Fed chair to be the chair of the FOMC. They are not exactly one and the same thing. And these are the sorts of things that I think would potentially happen if the remaining members of the Fed started to see Fed independence as being put under threat. So even if, bottom line, a very dovish Fed chair were to be put into place, there is a serious question as to whether that would even still lead to the very aggressive Fed funds rate cuts that I think President Trump wants.
Okay, great. Yeah, very important reminders there. And lastly, David, you just came back from a trip to London, and I saw your note on the back of that trip. Just any quick highlights on anything that struck you the most in terms of investor views?
Yeah, I think worries have certainly increased that there could be a sustained period of weakness or even an acute crisis in long-dated developed market government bonds, and that's not specific to the U.S. We've had a number of episodes in the past few months that really do start to add up to a pattern. Obviously, there's been a lot of weakness in back-end Japanese government bonds, JGBs, with the election coming up. I won't delve into that right now. I know that'll be covered elsewhere in this podcast. we had a very severe sell-off in 30-year gilts on the back of what was really, from an economic perspective, a very small backtracking on fiscal rules there. And then, of course, in early April, there was a very aggressive sell-off in U.S. Treasuries on the back of Liberation Day tariffs being announced significantly higher than at least the market expected. And so I think this is leading to increased worries that these are not necessarily isolated episodes. These could really be the start of a bigger pattern. And it's definitely something to watch out for, definitely a theme. DM debt levels are very high as interest rates have gone up and refinancing has occurred at higher levels. Interest expenses have gone up significantly for many countries, not just the U.S., and I think this is definitely a theme to continue to look out for in the coming months and into 2026.
Yeah, brilliant. Yeah, thanks very much, David.
My pleasure.
Okay, now let's go to London, and I'm joined by Andre. Hey, Andre, thanks very much for joining again in this podcast.
Hey, Eben, thanks. Always a pleasure.
So let's start with the topic of the day, I guess, on the trade deals with the U.S. Obviously, the big one that we're watching is on anything that might come out from the EU, given the threat of a 30% tariff. What do you expect from that in the coming days or weeks?
I mean, look, that letter on the 12th of July where Trump threatened 30% versus Europe, I mean, that's clearly far worse than anyone really expected. That said, our view at the moment is very much it's all essentially a bargaining tool on Trump's part ahead of the 1st of August deadline. Essentially, there are two factors. Either we think you get a deal to some extent or some sort of agreement in principle, which allows the EU and the US to negotiate further, or you end up in a scenario whereby actually Trump simply postpones or prolongs. Essentially, he sort of chickens out in a way, as has been the case until recently. I think the key sort of question that investors have at the moment is what happens if we don't get a deal, or what happens if he doesn't chicken out? And I think the question then is, will Europe retaliate? So Sefcovic, who's the European Commission trade commissioner, has suggested, and I quote, the EU will consider all well-considered proportionate countermeasures should a deal fail. I mean, in reality, I'm very skeptical of the EU's willingness to retaliate against the US, given the credible threat of Trump escalating. And it's also worth bearing in mind, we're also skeptical of the EU's willingness to impose sufficient tariffs against China to prevent goods dumping.
Right. Okay, that's very interesting. And we have the ECB coming up next week. How do you expect the ECB to think about this uncertainty with the tariff, and what do you expect them to do on the interest rate?
So there have been a variety of sources, stories saying the ECB will look at the prospect of 30% tariffs. It's worth bearing in mind, in the ECB's initial analysis published back in June, they only considered three scenarios: 0%, 10%, and 20%. No one was thinking about 30%, despite the fact Trump had actually posited 50% on Truth Social. But generally speaking, I'm not really expecting this to complicate the ECB's July decision. The ECB has been very clear in all of its recent communication. They want further clarity on tariffs, as well as the impact of tariffs on the real economy. So I think the ECB will be unwilling to preemptively cut at the July meeting, and essentially would rather wait until September, when the ECB will then have further clarity, hopefully, on tariffs, but also have additional data on inflation, activity, and also those all-important new forecasts.
Right. Okay. So staying patient for now, which I guess is interesting because some central banks in Asia have decided to be actually preemptive and, responded with easing in light of increased uncertainty on the trade front. And then finally, what are you expecting in terms of the data calendar? Is there anything that you're watching closely?
No, sure. Look, I mean, actually, there's a fair bit of data out during the course of the coming week. I would say the most important thing, certainly from a market perspective, is going to be the flash PMIs for the month of July. We are forecasting an uptick, certainly on the European PMIs, but obviously it's worth bearing in mind, and we caveat here, there are downside risks from this 30% Trump tariff letter. That said, these are surveys of corporates, and it's actually asking corporates, how has output this month changed versus last month? So even though you have this Trump tariff letter threatening 30%, it can impact sentiment, yes. In reality, it shouldn't feed into actual output currently. As we saw in April, for example, manufacturing output rose in those indices, whereas services sector output declined. And obviously, tariffs are going to impact manufacturing, not services.
Okay, great. Yeah, sounds like a busy week ahead for you. Thanks, Andre.
Thanks, Euban.
Okay, now let's go to Hong Kong. Hey, Jing, thanks for being here to discuss China, where a few things are also happening.
Yeah, thanks, Euban. Glad to be here again.
Yeah, we don't have much on the data calendar next week, but we've had the second quarter GDP numbers out earlier, as well as exports, which appear to surprise on the upside. How does that affect your growth outlook for the rest of the year?
Yeah, so lots of things are happening right now in China. We had those data exports rebounded in June. That's mainly because of the pent-up shipment to the U.S., following the tariff truce. And the export rebound boosted industrial production growth to an impressive 6.8%, and also, Q2 GDP, which came in at 5.2%, above our forecast of 4.8%. And so given this better than expected Q2 growth, we slightly raised our annual GDP growth forecast for this year to 4.6% from 4.5%. But not everything is rosy. Despite those robust headline number, retail sales and the fixed asset investment dropped notably in June and missed the consensus forecast. That's because of a few things. And number one, the new austerity measures started to impact the catering services and the sales of tobacco and alcohol. And the second, we have seen some initial payback from this durable goods trading program. And also, manufacturing investment slowed very sharply. I guess it's because the drag from this uncertainty on the trade front. Elsewhere, we still have this deepened contraction in the property sector, evidenced by both home sales and prices, especially in top-tier cities. And we think the export rebound in June should be short-lived, given so many, headwinds on this sector. So put all the things together, we still maintain our GDP growth forecast for the second half at 4.0%. So that means a sharp slowdown from 5.3% in the first half.
Okay, got it. So still sounding a little bit more cautious, at least in the near term. And speaking of exports, any latest updates on U.S.-China relations? Is the de-escalation that we've seen so far remaining intact?
Yeah, so this is a very interesting topic right now. Early last week, it was widely reported that the U.S. government is drafting a new rule to ban the shipment of advanced AI chips to Malaysia and Thailand, because they want to block the backdoors for those chips flowing into China through those two countries. But however, this week, as of sudden, a couple of U.S. tech giants have received permissions from the U.S. government to resume the direct sales of AI chips to China. Interestingly, the U.S. Commerce Secretary Howard Lutnick even commented that it is the U.S. interest to keep Chinese companies using American technology and even get them addicted. So considering this course reversal on advanced chips, and we had this meeting between China's Foreign Minister Wang Yi and the U.S. Secretary of State Marco Rubio over the past weekend, and potentially a summit, between President Xi and President Trump sometime later this year. So it looks like both sides have a strong desire, to manage their tensions, and their relation should have stabilized, at least in the very near term.
Okay, sounds quite positive then. And finally, any other things you're watching closely, at least in the next couple of weeks?
Yes, I think I'm closely watching this mid-year Politburo meeting. Given this decent, robust GDP growth in the first half, I think Beijing is under a little pressure to rush to announce a big package of stimulus measure, especially on the demand side. However, we had this very high-profile meeting on the 1st of July, chaired by President Xi, and that meeting, followed by a series of state media reports and industry meetings, suggest that Beijing is quite serious about addressing the overcapacity issue, especially given the entrenched deflationary pressure in China. Just look at the GDP deflator in Q2. It worsened to the lowest since the global financial crisis, and it has remained negative for 10 out of 11 past quarters, right? So it's reasonable to suspect Beijing might put more focus to fighting the deflation through the supply side, right? Especially given the growth is still largely okay. So I think the July Politburo meeting would be a key event for markets to watch on whether we will see more confirmation on the Beijing's determination on this campaign, and whether we will see more specific guideline on the capacity cuts in certain sectors.
Yep, always fascinating. Yeah, thanks very much, Xing.
Thank you, Ruben.
Yeah, finally, let's go to Tokyo. Thanks, Kengo-san, for joining today. Really appreciate it. We have this very important event this weekend. In fact, on Sunday, the upper house elections in Japan. Given the uncertainty, what are your scenarios around the outcome, and what are the latest surveys saying?
Okay, so some news media reported that the ruling party may not get the majority in the upper house based on their public poll. So in response to that, we consider there will be three scenarios regarding the outcome of the election. First, the ruling party, which is a coalition of the LDP and Komeito, will keep the majority in the upper house. The second one is that the ruling party fails to keep the majority with a small margin. In this scenario, the ruling party will get more than 40 seats in the election, but not reach 50. Thirdly, the ruling party will lose the majority with a large margin. In that scenario, the number of the seats which the ruling party will be well below 40.
Okay, yeah, very interesting. And just trying to get a sense of why these upper elections are being closely watched by markets, I think more than usual. What are the key implications of these outcomes on the economy, but also on policy?
Okay, so usually, as you said, the upper house election does not get attention because the constitution of Japan puts supremacy on the lower house in some fields, including national budgets. However, if the ruling party loses the majority in the coming upper house election, their political advantage on opposition parties will be largely reduced. And if so, the Prime Minister Ishiba may step down to take the responsibility of the rules in the election. And moreover, opposition parties are advocating consumption tax cuts in this election, while the ruling party is advocating only cash handouts to households. So the outcome of the election has the potential to affect the large influence on the economy. In this regard, the government may include consumption tax cuts to pass the bills in the next year's diet if they lose in this election. Yeah, so if the ruling party loses the election, the next the prime minister may be from opposition parties rather than the ruling party, because the crushing defeat of the ruling party will reduce its political power significantly. In this first scenario, if the ruling party can maintain the majority in the upper house, the Prime Minister Ishiba will continue his cabinet and will implement only cash handouts. We expect it will have only a subtle impact on the economy in the first scenario.
Okay, got it. Sounds very significant. And yeah, the results, when do you expect them to be coming out?
The vote opening will start from 8 p.m. in Japan, July 20th. So some media may report the expected seats based on their polls, but the official outcome will be next day, July 21st.
Okay, got it. Yeah, I guess everyone's going to be watching that very closely. Thanks again, Kingo-san.
Thank you so much.
That's it for now, and thank you again for listening to our podcast, edited and produced by John Dalton. Please like and subscribe to Nomura's podcasts on Apple, Spotify, and SoundCloud, or your usual podcast provider. We'd love to hear your feedback, so please feel free to write a review and share this podcast to anyone you think might be interested. You can check out NomuraConnects.com for more of our research and updates. Have a great week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting, or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.